Good morning, everyone. Equities got the most attention overnight as the U.S. stock market fell sharply and closed near its lows for the day. The market was led down by oils, which have been falling along with the price of crude, and retailers. A Wall Street Journal story noted a survey showing that all but one apparel retailer missed forecasts in December and observed that this may bode ill for today's U.S. retail sales figure. The Journal story said this, quote, may encourage a more cautious approach on easing stimulus efforts, which hurt the dollar. On the other hand, Atlanta Fed President Lockhart, a non-voting member of the FOMC, said he hadn't changed his view on tapering off the Fed's bond buying program. That echoed what St. Louis Fed President Bullard said on Friday. That raised the likelihood of further tapering at this month's FOMC meeting, which is bad for stocks, perhaps, but dollar supportive. So the dollar recovered much of its losses, and this morning is trading higher against most G10 and emerging market currencies. Later today, we've got Philadelphia Fed President Plosser and Dallas Fed President Fisher speaking. If they, too, come out in favor of continuing with the taper, then all doubt should dissipate. That could outweigh a weak retail sales figure and prove dollar supportive. Headline retail sales for December are expected to slow to plus 0.1% month-on-month from plus 0.7% month-on-month in November. Excluding autos and gasoline, sales are also forecast to slow to 0.3% month-on-month from 0.6% in November. In any event, my research has shown that over the last 12 months, the retail sales figures had relatively little impact on eurodollar, particularly on the day of the announcement. And on average, eurodollar was lower, or in other words, the dollar stronger, a week later, regardless of whether the headline figure beat estimates or not. So it looks like something besides the retail sales. Probably tapering is the crucial thing here. Now, the focus in European time today will be on the CPIs. We get December CPIs from France, Sweden, Italy, and the UK. In the Eurozone, French CPI is expected to have risen 0.4% month-on-month in December against an unchanged figure in November, while Italy's final release is, as usual, the same as the initial estimate, 0.6% year-on-year. Now, ECB President Draghi commented recently that the drop in inflation in the Eurozone in December, according to the preliminary data, was due largely to a technical change in the way they calculate the CPI statistics in Germany. So there may be more attention than usual paid to the French and Italian data in order to see whether the trend of slowing inflation is in fact gaining traction in the Eurozone, or is it just due to this statistical fluke in Germany. UK inflation estimated to be up 0.5% month-on-month, an acceleration from 0.1% month-on-month in the previous month, but that'll just keep the year-on-year rate at 2.1%, which is pretty close to the 2% inflation target of the Bank of England. And that would allow the Bank of England to keep rates lower for longer. Hence, it's potentially sterling negative if it's not already discounted in the market. Meanwhile, the UK purchasing producer price index is estimated to have shown no change on a month-to-month basis in December. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.